Debt Market Update, August 2020. The yield of 10-year benchmark G-Sec ended the month of August 2020 at 6.12%, up 28 basis points over the previous month end. This was driven by a pause by RBI against market expectation, high inflation, and relatively hawkish MPC minutes. The AAA corporate bond spreads over 10-year G-Sec yields also inched up by 12 basis points during the month. The average net interbank liquidity surplus remained at elevated levels, supported by high government spending, soft credit growth vis-à-vis deposit growth, and foreign exchange purchases by RBI. The FPI debt flows in August 2020 were marginally negative at $0.08 billion as compared to net outflows of $0.6 billion in the last month. During the first 5 months of FY21, net FPI outflows from debt stood at $4.9 billion as against net inflows of $3.6 billion during the same period last year. On 31st August 2020, RBI unveiled multiple measures to ensure orderly market conditions and congenial financial conditions. Till now, banks were allowed to hold more than 25% of their investments under the held-to-maturity category, provided the excess is invested in SLR securities within an overall limit of 19.5% of NDTL. In a significant move, it increased the HTM limit for banks from 19.5% to 22% of their NDTL. Securities which are classified as HTM are not required to recognize mark-to-market gain or losses. Hence, banks' profitability is protected against yield movements on such investments. Thus, the step should encourage banks to invest in government securities. RBI also announced a plan to conduct Operation Twist of INR 200 billion in September 2020, in addition to INR 200 billion already announced in August 2020. Further, RBI will also conduct LTRO of INR 1000 billion during mid-September to ease liquidity pressure because of advanced tax payments. Following the announcement, the benchmark 10-year yields fell by approximately 18 basis points on 1 September 2020. The US Fed also revised its policy framework and announced that it will target average inflation and will tolerate higher inflation for periods following periods of low inflation. Further, it will not preemptively raise rates on reaching high employment unless the inflation rises. This, in effect, implies that the US Fed is likely to maintain low rates for longer and will not be raising rates proactively to curb inflation. Outlook. While RBI's decision to hold rates came in as a slightly negative surprise, release of MPC minutes for the August 2020 meeting triggered a sharp increase in yields. The minutes highlighted concerns of most MPC members of rising inflation despite weak growth. While most members attributed the same to food inflation and supply-side shock, concerns were raised about it becoming durable and the possibility of inflation becoming more broad-based. Since the release of MPC minutes, the 10-year benchmark bond yield rose by approximately 40 to 45 basis points and ended the month up 28 basis points. The measures announced on 31st August 2020 should support softening in yields going forward. Over the past few months, apart from reduction in policy rates, RBI has been conducting Operations Twist, LTROs, TLTROs, open market purchases, etc., to ease the financial condition and improve liquidity. Recently announced measures also confirm our belief that RBI is open to taking both conventional and unconventional policy measures to counter the impact of slowdown due to the pandemic and ease pressure on yields. Further, various statements by the RBI governor highlight that aiding economic recovery weighs significantly on the monetary policy decisions, and the available space can be used at the opportune time. Apart from the factors mentioned above, weak oil prices, positive outlook on balance of payment, benign inflation outlook over medium term, lower global rates, and ample global liquidity bodes well for yields in India, and thus there is some room for yields to decline in our opinion. However, any sharp reversal in oil prices, high near-term inflation, overhang of high supply from central as well as state governments, etc., are the key risks to our view. In view of the above, yields at the longer end of the curve are likely to trade within a range in the foreseeable future. Considering the aforesaid factors, we maintain our view that the short to medium end of the yield curve offers better risk-adjusted returns. Thus, we continue to recommend investment in short to medium duration debt funds. Further, driven by high liquidity and improving sentiments, corporate credit spreads have eased significantly from recent highs. However, bond spreads of select issuers, especially in non-AAA rating category, are still trading at attractive levels and opportunities still exist in select pockets. Hence, allocation to credit-oriented schemes can be maintained or increased to a certain extent. Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.